Welcome to Morningstar. My name is Christopher Johnson, and today I'm joined in the studio by Michael Browne, the CIO of Currie. Thank you for being here with me. So, my first question to you is, according to Morningstar data, the FTF Currie UK Equity Income Fund lost £229 million. So, what do you put the outflow down to?
So we've got this issue in the UK where we've had really substantial cuts in the amount of money that people invest in the UK by the UK citizens, and they're being driven by their IFAs and they're being driven by their pension funds as well. So I think that position is really disappointing in the short term, but from what I can see, with pension fund holdings down to 4%, with people's and in particular the IFA market, recommending quite low weightings in the UK, and with the prospects for the UK rising quite significantly at this moment in time, I can see that this is the bottom of that particular market and the bottom of that particular trend. What I would say is in the FTSE 250 area, I think that we are now the largest fund in that particular investment area, as a lot of the funds that we've seen around us have lost very significantly more amounts of investor income.
You mentioned you expect there will be a rise in UK equities. What do you put that down to, and does it have a lot to do with the fact that we've got a new Labour government in power?
Well, let's put two or three pieces together, and like any good jigsaw puzzle, you can only solve it with a number of pieces. So the first piece is absolutely the stability that's now offered to us as a result of having a government, large majority, seemingly fiscally very neutral. So the markets like its outlook, like its behavioral type, seemingly a little bit more internationalist, so a little bit more positive towards our major trading partners of Europe. But that's always combined with other elements as well. UK GDP has really significantly outperformed the forecasters' expectations over the last 2 or 3 years, and we had quite a big upgrade in the post-COVID numbers from the ONS as well last year. So the UK economy seems to be in pretty good health. Unemployment levels are pretty low. Our wage rates are rising at a decent lick on a real basis at this point in time, recouping the real income losses. We then have, as a result of the last 8-9 years, cash outflows in the market, people divesting from the UK, and as a result of actually pretty decent corporate performance, the UK market that sits at one of its cheapest ever levels when we're looking against world markets. So when you bring all those elements together, that's really interesting. If you also put the other side of the coin, whereby things in France look a little unstable, things in Germany are not particularly stable, we have an unstable world at this moment in time, the UK could, if its economic management is stable and secure, could actually look like a really interesting investment for low inflation and good growth levels over the next 2 or 3 years.
And so do you expect that UK small and mid caps will benefit from the environment that you've been talking about?
Yes, I do, actually. And I think, we've had good performance. And in particular, if you go back to 21, we have very good performance from our very large caps. And they are very much dominated by overseas earners. Now, part of this is going to be that sterling, again, fact that's been very weak, is likely to rise. We've seen it touch 130 against the dollar this month. We've seen it rise against the euro as well. So that optimism also coming into sterling will start to just devalue the international earnings of those big, large multinational companies that we have in the UK. And at the same time, with accelerating GDP growth within the UK, the small and mid caps become much more attractive as the vast majority of their income comes from UK GDP. So yes, you have this kind of slight double positive here as a result of the structure of the UK FTSE versus the structure of the UK 250.
We talked a little bit about the new Labour government, but what challenges do you think they will face in trying to kickstart economic growth, which is something that they are prioritising?
Yeah, I think there's really 2 or 3 very simple challenges. One is, if you saw a lot of money in the UK economy, and let's face it, we did have a prime minister two prime ministers ago who tried that, it could be extremely inflationary. The markets will react extremely negatively to that. So you can't have some great fiscal pump priming. It has to be very careful. Bank of England will react negatively to that. They'd raise rates. You don't want to be raising rates at this point in time when the rest of the world is looking to cut rates. So first of all, you have to be careful with the economy and careful with the inflationary outlook for the economy. And again, at a 4.4% unemployment rate, we've got very low levels of unemployment. You could easily create a squeeze in terms of wages at this moment in time if you try to go too fast. On the other hand, there are certain areas of the economy that clearly need improving and clearly need development. And the Labour Party has focused on house building, and it's quite interesting if you look over the peak in house building where the UK built 425,000 homes in 1968. Half were built by private companies, half were built by local authorities. To today, 2022, where we built just 200,000, that's a drop of 53% in the number of homes that have been built over that period of time. And over that time, the population's increased by 23%. House building today accounts for just about 2% of GDP. Now, if you look at those numbers, and if you were to get up to that 300,000 level, clearly you would add 1% to GDP straight away at this moment in time. How do you do that in the space of time available? Because this is going to be legislative. You're going to need to change the planning laws. That's where the focus has been. But the other side of that is finance. You need to get some system in place here where the consumer can get long-term finance at fixed rates, which are competitive, so that you take away the risks of owning property and having interest rates move against you, as you see in the United States. And last but not least is demand. I don't think I'm that worried about demand, looking at the issues that we have in terms of the population growth, in terms of the pressure on housing, in terms of the increase, in terms of the demand for housing, in terms of family formation, etc. So that side, I think, is there. But the real question I think that they haven't addressed here, or are not going to address, is actually finance. And that, for me, is the critical element. Planning, returning to the previous planning system of targeted number of houses per local authority, is a very strong idea. It's a good idea. We know it works. But will it be enough in the time available at the length of this Parliament to drive that number from 200,000 units to 300,000?
On housing, in your view, which stocks within the sector are going to benefit from, the planning reforms that you've been mentioning?
Yeah, so we are very optimistic for Taylor's, one of the large house builders, and I think they're a good balance sheet, strong return of capital to shareholders as well. So they keep the shareholders in mind from that point of view. So we think it's well managed, good, and with a strong land bank, which they could accelerate if the conditions are right. And the conditions do need demand and finance as well as planning to be right. On the other side, slightly the smaller side, where we do think Bellway is really interesting. We think, again, Bellway's got the opportunity set to go forward here. But as I said a little bit earlier, one of the big drivers here, if you're going to get past that 300,000 unit level, has to be local authority building, has to be some degree of local authority buying. And we haven't got anything in place for really enabling that at the size and scale that we saw back in the 60s, where half of all houses that were built by local authorities and half were built by the private sector. So if that's going to happen, then there's going to be a very different process that's going to be in place. The house builders are going to be absolutely needed because they're the only people with the expertise to build those products. And that's where I think that extra demand could come. Would it be at the same margins they make today? Perhaps not, but I think the volume and growth there will be really interesting.
On UK equities, we've seen a lot of takeovers at the moment. Should investors be concerned by the fact that the UK equity market is shrinking?
I think actually investors should be looking at that and saying, why am I not involved? The reason why we're getting takeovers is because we've got very good companies, quite often quite unique companies, and extremely cheap multiples and valuations, and where the managements are saying, yes, we can't get this valuation from this market. So actually, if somebody would like to bid a very significant premium for us, we will take it. It doesn't dull the innovation that we have in the UK. I don't think it will dull the pipeline of new IPOs coming through to the market, although they will all be at the smaller and perhaps a mid-cap end. But what it will do is it says the UK market is extremely attractive, both for the private buyer and indeed for the corporate buyer. And I think that's the piece that's most important at this particular moment in time, rather than some worry that the market is shrinking or that they're worried that there is no new innovative companies coming to market. That I'm not too concerned about at all.
I also wanted to ask you quickly about defence. I mean, we're in a very strange period, let's say, and there's high, geopolitical risk all over the world. Do you think that UK defence stocks are, set to benefit from, what's going on globally?
I think UK defence stocks have done. I should say that this is an area where we are looking from a sustainability point of view that we would tend to exclude these stocks. There are some elements that we would include and some elements that we would exclude. So just let me put that as a slight commentary around that. Now, these stocks have moved quite significantly over the last couple of years in response to geopolitical events, and those geopolitical events have been very difficult and very tough. There is going to be an increase in expenditure around Europe as a percentage of GDP on defence, and that's going to be a long-term changing picture, in particular because the pressures coming from the US and the US providing the, shall we say, the umbrella cover for Europe seems to be slowing down, and Europe needs to be able to pay for its own defence in a way that it has not done so during the 80s, 90s and 2000s. So that's the backdrop to demand. The backdrop to demand is quite decent. The flip side to that is actually what parts of the defence market are going to be demanded. So which particular elements are we doing here? We've seen quite a significant change in the style of warfare that we've seen in the Ukraine, very much becoming technologically driven and very much around drones and surveillance. So if that's the case, do we have the corporates that are able to produce those types of weapons as opposed to the other types of weapons, or indeed the more defensive shields as well? So I think we need to think about the technological elements of the defence companies rather than just think just about the elements that we see today, which is a general increase in the expenditure in defence. Let me just put one other slight caveat to this. We've had significant geopolitical risk and really very difficult conflict both in the Ukraine and in the Middle East. That conflict has been ongoing for really quite a long period of time. I think there's significant opportunities here to try and de-escalate some of that conflict. Conflicts don't go on forever. So I would suggest that there is, if I look forward over the lifetime of the next parliament, some degree of optimism that some of these conflicts will actually quieten down over that period. But that doesn't take away from the long-term structural rise in defence spending.
And back to the FTF Martin Currie UK Equity Income Fund. So Unilever is the second top holding of the fund. What is your view on the company's focus on high-end cosmetics and its plan to offload lower margin divisions? Do you think that this is the right strategy to take?
Yeah, we are slightly overweight the Unilever position. Obviously, it's big stock in the UK, and it's obviously a large foreign earner as well. So my comments about the impact of a rising sterling have to be taken on board. However, we really like the restructuring program that they're putting through at this moment in time. We really like the focus on higher margin businesses and longer term growth businesses. We like the sale of the ice cream business, much as I like ice creams in the middle of summer. But actually, no, that's a good sale that they're pushing through at this moment in time. And when I look at the comparative companies around the world, I see this at about a 25-30% discount to similar companies in similar areas. So I think there's both a re-rating story available here and strategically the company's getting it right.
And also, why have you added to your position in National Grid? According to Morningstar, you added 753,000 shares. Why is that?
So that's very straightforward. So obviously we had a large rights issue a couple of months ago in National Grid, which we participated in, and we were very keen to participate in that, in particular with the view that the area of National Grid and investing significantly more in electricity supply and distribution is something that is going to be accelerating over the next 5 to 10 years. And we see that from the King's speech yesterday, with a focus on large investments and a new investment bank based in Scotland to drive forward investments in the grid and offshore solar, wind power, etc. So I think there is a real opportunity for National Grid in the UK. But similar opportunities also exist in the US, notwithstanding who is in power, in the same area of electricity generation and distribution. So This looks to us like a company that was raising money for the right reasons for higher rates of return over the very long term, and we're excited by its prospects.
Michael, is there anything else you'd like to tell me that I haven't covered in the interview?
I think the one issue is always time, Christopher. We always have to be cognizant that structural changes in any economy will take time. The UK starts in a good place. However, to get to the sorts of level of growth of 2 to 3%, which we saw pre the GFC, will take time to reorganize the economy to get to that particular point in time. So I think patience is going to be a virtue. But with the levels of valuations you have in the UK market at this moment in time, that patience will be rewarded.
Michael, thank you for being here with me.
Great pleasure. Thanks, Christopher.
This is Christopher Johnson for Morningstar UK.